want to start now?
Great.
So, shall we start? Yes, let's go ahead and start. Okay. So we have begun. Thank you, everyone, so much for coming, and thank you for those of you online who are also joining us. My name is Martin Fackler, and I'm going to be the MC today of our event. Before we start, just some quick ground rules. I would like to, if possible, do this as a dinner discussion. People can talk, and but at the same time, I want to make sure people have a chance to talk. So, if you have something to say, please raise your hand, and we'll give everyone a chance to talk and ask questions. And then if we get questions online, those will be brought to me, and I will read those, because we'll have about 20 people online at the moment. We have about 20 people. So it's our great pleasure today to have this luncheon with somebody who I think we all know, who's been an important presence in Japan for quite a number of years. I remember when, of course, I'm talking about Nick Bennis, and I remember when Nick was a voice in the wilderness talking about governance reform back in the Koizumi era. You remember Bulldog Sauce and was it Warren Lichtenstein?
Yeah.
And there was a time when hedge fund was a bad word, and Nick was calling for things then, and he kept calling for them, and honestly, he prevailed. And so we're going to hear his story, what about him first and what he did, but then we also will hear from Nick about where are we now. So this idea of companies serving shareholders, of shareholders having a legitimate place at the table seems to be gaining hold. We'll see what Nick says. Big companies, national champions like Seven & I. We've seen big changes. Things are happening. Companies are acting differently. Efficiency of capital, all these things matter in a way that we didn't see before. So very quickly to introduce Nick, I didn't know this, but you have a BA in political science from Stanford University. Was Daniel Okimoto your professor?
No, I can't remember who it was, but it was not Daniel Okimoto.
Okay. And Scott Callan went to Stanford too, right? So,
yeah, after that, yeah.
Okay.
He's younger than me. I'm an old man.
And you have a JD and MBA from UCLA.
Right.
And he'll tell a story, but I think that today, Nick did a lot of things at ACCJ and elsewhere, but consistently kind of arguing for corporate governance and focusing on the issue that we're going to talk about today. Today, he is an independent director at Advantest. We all know, a very well-known Japanese company in the computer chip area. And he's also the representative director and founder, right, of the Board Director Training Institute of Japan, which is a nonprofit that trains executives and board members in corporate governance and also corporate directorship. But I'm going to leave it to Nick to tell his story. So I will, without any further ado, I will turn the conch over to you.
Thank you very much, Martin. It's been a long time since we met personally, outside of LinkedIn or something like that. So I'm very happy and thankful for this opportunity to present my views to the Foreign Correspondence Club of Japan. Thank you very much for inviting me.
Thank you for coming.
So some of you may be wondering, sort of, who is this guy, Nick Bennis? And so I want to give you a sort of a little self-introduction that will explain why and how I'm related to the themes of corporate governance, growth strategy for Japan, the economy, governance reform, and that sort of thing. I'm the CEO of the Board Director Training Institute of Japan, which is a public interest nonprofit, just like you are, a very special kind of nonprofit that's regulated by the government. And what we specialize in is training for directors, directorship, and governance training for executives, et cetera. And we founded this 16 years ago, in 2009, back when governance was not much of a topic in the media. It's sort of a super B Corp nonprofit. But going further back, my relationship to the topics referred to can be divided really into two time periods. One, when Japan was the sort of wonder child economy that I admired greatly, and then a second period when I realized its problems and limitations and spent many years trying to find ways to help change policies or change companies to fix them. I first came to Japan in 1975, a long time ago, as a sophomore at Stanford, at the age of 19, to study Japanese, first at Sophia University and then at Keio. I came because I was fascinated by Japan's fast economic growth and its position as the first non-Western nation to industrialize at the time. Others have done it since then, but they were the first one to do it 100 years ago or more. And the fact that it has done so rapidly, I thought if you could learn the secrets of what made Japan able to do that, we could share those secrets with China, India, and other countries. I was fascinated by this. So I had to learn more about this place, and I went to it, had to go to the country. And then later on, when I was getting my JD MBA at UCLA in the early 80s, I spent 2 years doing analysis and interpretation at a huge research project funded by the US Navy to Professor Bill Ochi at UCLA Business School. He was the author of the best-selling book called Theory Z, which extolled certain Japanese management practices, such as strong company culture, employee involvement, and long-term employment contracts that fostered teamwork and trust and a sense of belonging. These, in organizational science, are aspects of clans as opposed to bureaucracies, which Western companies tend to depend more on. That's organizational science. But that's what he was studying about. And this project was funded by the Navy. It sought to research the policy and societal organizational secrets of Japan that might have helped it succeed so well. After graduating, I decided I did not want to become a boring lawyer. I did that as a trainee for one summer and didn't want to do it anymore. So I passed the bar in California and New York, but then I became an investment banker at JP Morgan and spent 11 years making a undeserved, often, sometimes disgustingly large amount of money on big transactions that got done because governance at Japanese life insurance companies and other institutions was so poor. Among other things, I just, by way of passing, it may be interesting to note, I landed the assignment to sell the portion of Rockefeller Center that Mitsubishi Estate had to get rid of because they had vastly bought it for too high a price. And that's a whole other fascinating inside story of poor governance that I will share with you if you're interested to report on that or talk about it anyway. I then set up an M&A boutique and headed it as a team, and then we made our own company. And I did that for about 12 more years, and along the way, I started to serve as an independent director at various companies. I've done that now for a total of 17 years. So 17 years, been on various boards here. And that included being appointed to the board of Live Door Holdings after the scandal to help clean it up. It was a complete year out of my life. I didn't do anything else. And before that, at a map data company that went bankrupt because I could not convince the board to sell the company to an internet company like Yahoo, who was in fact interested. I had contacted them. And who then ended up getting, Yahoo ended up getting all of our high quality map data later on when we went bankrupt. They got it for zero, paying nothing. That's what happens when you have poor governance. And by the way, I learned in that event, which is my first bad experience in governance, that when things go bad in governance, it's personal pain and anguish that also results. In this case, the founder's son, who was the ex-president, I had actually helped fire him because he was a good guy but just wasn't up to being president. His guarantees, his signature on the guarantees of the loans was still there. So he went personally bankrupt as a result of this bankruptcy. That was very painful to watch. So early on, as a banker and director, during the bubble and in the mid-1990s, it had become very clear to me that chronically poor corporate governance was a major problem holding back both Japan's economy and investment from abroad via win-win M&A transactions. And so over the last 30 years, on a steadily escalating basis, I produced a very large number of articles, policy viewpoints, and interviews both those done as chair of the FDI committee at the American Chamber of Commerce in Japan, and most of them done on a solely personal basis, on my own cognizance, because I had an opinion and expressed it, and it was printed. And I sat on various government advisory councils to the Cabinet Office and also the FSA, Financial Services Agency, related to foreign investment or corporate governance. In 2010, I got myself elected as governor of the American Chamber in Japan for the second time, specifically in order to spend most of that year, what ended up being sort of killing myself, as it turned out, proposing and then leading a large project that we called the Growth Strategy Task Force. Because I was concerned, and many other members agreed with me, that Japan's economic trajectory at that time posed a big problem for the country and our members, because the ratio of government gross debt to GDP had risen to 200%. It's now 260% or so, much higher than other developed nations at the time. Even Italy then was only at 125%. Japan needed its economy to grow faster. It was going to pay down all this debt, and so that my children, who are dual nationals living in Japan, would not be saddled with a huge tax bill now or later, or that Japan would not become an unattractive market to invest in. So there's only three ways, when you look into this, to grow an economy faster. You can grow the population faster, but Japan's population is shrinking, as we all know, at an alarming rate. You can invest more capital, number two, but Japan had a lot of capital. It was just being underutilized. Number three, and this is the key, you can increase the productivity of both capital and labor. The case of Japan's woes in the last 30 years, the lost decades, were all about sluggish productivity and growth in Japan, which never inclined again. Japan had stopped catching up with other countries, US and UK, in terms of productivity, labor productivity, and total factor productivity. So I immediately commissioned the most respected economists in Japan with respect to productivity economics to write a report on what are the causes of this sluggish productivity growth. And this person was Professor Kyoji Fukao at Shitotsubashi University. He had done a lot of analysis. We asked him to do much more analysis with new firm-level data, right? Minute firm-level data that he had helped develop as a leader at Rieti, made his think tank. And our mission to him, given to him, was to identify the reasons for Japan's decline in productivity growth. Major reasons that came out of their 100-page report, he worked with another academic, included inefficiencies in the labor market, the presence of zombie companies that were not being sold to better owners or being shut down because they're not profitable, and underinvested capital sitting in bank accounts. So this all pointed to the need to reallocate capital to more profitable businesses, purposes, and uses, and to increase what they called, the professors called, economic metabolism, which is basically the speed of these transaction reallocation taking place. In other words, we needed a more active capital market and governance to drive management to make changes faster, in a nutshell. So based on 100 pages of complex analysis by the two professors, mainly Dr. Fukao, in a fat white paper, which I wanted to show you, but I forgot to take it out of my briefcase, so I can't show you, but I can send it to you later if you like. We put together 100 pages in Japanese and 100 pages in English based on the economic analysis, where we proposed that instead of organized tax breaks or subsidy measures that corporations were randomly asking for, Japan needed a coherent, rational, economics analysis-based growth strategy, a really coherent growth strategy, a thought-through one, not a random one, that could increase sluggish productivity growth. And we proposed many concrete measures in 8 different areas, such as labor law, taxation, immigration, entrepreneurship, education, internet, and of course, corporate governance, that needed to be put in place. And most importantly, we stressed to the government directly, it was addressed to the government essentially, we stressed that strong political leadership was essential in this process to take the most important policymaking direction out of the hands of the bureaucrats, focus in the right areas, and require analysis to move ahead. This white paper, which I will show you later if I have a chance, was far more successful than I ever dreamed possible. It was very widely read in Kasumiseki in the government and by the LDP. METI immediately started saying the same things we were saying, some of them, and the government took our advice to the letter, really, and exercised political leadership when the Abe administration was elected at the end of 2012 by setting up a growth strategy council that did not include bureaucrats, but did include academics, one of which, of course, was Professor Fukao, our professor. Though no one would ever admit it, this report is the intellectual capital of Abenomics structural reform, the all-important third arrow that you may recall was discussed about 10 years ago or more. And that is what enabled me to propose the concept of a governance code for Japan, first in a Wall Street Journal article, then to the Bank of Japan, a senior person, very quietly, and then to the number 3 LDP parliamentarian, Yasuhisa Shiozaki, who's really the hero of this whole story. In the fall of 2013, in a series of meetings, memos submitted by me, advisory emails, and so forth, and even including getting calls from Mr. Shiozaki with a lot of questions all of a sudden I had to answer immediately when I was in the middle of lectures. I had to step out in the hall and talk to him. He spoke after that and during that process to the FSA and the TSA to do sort of nemawashi and socialize the concepts. More on that in private, if you please, later on perhaps. Suffice it to say that not everyone was ecstatic about the idea of a corporate governance code, and there was an idea that the FSA should not be the agency in charge. It should be METI instead. And fearing that reaction, I knew it would come up, I had already put together with my lawyers a memo on why legally only the FSA would have or should have jurisdiction. Well, de facto head jurisdiction legally. So then, in early February 2014, at the invitation of lawmakers Shiozaki and also Masahiko Shibayama in the LDP, the latter of which is still a member of the Diet, I gave a speech proposing, this is a public forum, the press was there, Wall Street Journal was there, I gave a speech proposing the adoption of a corporate governance code to the LDP Growth Strategy Subcommittee in charge of finance. And my major argument was that without a governance code which prescribed best practices, and especially required a lot of disclosure of what kind of governance practices and how were being used at each firm, the stewardship code would never work. The stewardship code was then being discussed and almost put in place. I said, look, the stewardship code won't work if you don't have a lot more disclosure that investors can actually base their analysis on and do proxy voting based on. Without that, you have no basis for a comparison between companies and no basis for engagement in rational proxy voting, and nothing will work in the stewardship code. You're asking stewards to do something, and they don't have the information and the knowledge disclosure they need to do it. So the concept of, after that, the concept of a governance code almost immediately became the government's policy, really in a matter of weeks, in a fait accompli that moved so fast that the Keidanren could not beat it away, although they did make a try. This was because Prime Minister Abe was just dying to have something concrete in his second-year growth strategy, because the first-year strategy had reflected all of our task force's themes, but had been criticized because it had no concrete policy meat, no meat in the hamburger. So this very interesting backstory has never been described in the Japanese press, even though almost all of it is described in BDTI's blog and on our website, together with all the memos I submitted and articles I wrote at the time. It has been described in books like one I can show you later called Seeking Virtue in Finance by Professor J.C. Deswan of Princeton University, but never in Japanese, only in English, by other professors as well. While I have successfully proposed a number of other reforms, by far this one has had the greatest impact. As a result of the governance code, which made it publicly acceptable, and because of disclosure, meaningful and productive for investors to spend time engaging with companies about their governance and their management. Because of that, now, 11 years later, corporate Japan is being increasingly shaken up in a very healthy way for its own good and for the future of employees and the Japanese economy. So I'll give you a sort of litany of examples of what I mean by this. First, at the average prime-listed company, plausibly independent outside directors make up 46% of board members now. And almost all, and 20% of those directors are now female, by the way. In 2014, those two numbers were 15% and 3%. That's a big change in 10 years. Almost all companies now have nominations committees and compensation committees, even if they're not as active or effective as they should be. I should mention, however, that many outside directors are still not as effective, not so effective in general, and many, both new and continuing members, need to be trained, updated, or simply replaced, rather than just sitting on their resumes and getting paid for maintaining the status quo. Second, for the past 2 years, the TSE has finally started urging companies to improve consciousness and use of the cost of capital, which is great and much applauded. But I say finally because since 2015, the governance code has been the TSE's own code, in which the need to enhance capital efficiency was mentioned many times in the initial original 2015 version, and in which using the cost of capital was made very explicit in 3 different places in the 2018 revision of the code. More on this later in private, if you please. In other words, the TSE is finally taking responsibility for its own governance code, and indeed, to its credit, is becoming a sort of a quasi-activist in its own right, with policies that effectively force more disclosure and the use of the cost of capital, and try to force out companies that refuse to improve governance and improve their trading volume, or at least, and also they're trying to encourage them to price MBOs fairly and that sort of thing. So TSE is now on the move in the last 2 years. Third, because of the governance code enabling investors to complain about cross-shareholdings and other sort of allegiant, so-called allegiant holdings, as we call them, these holdings of stocks in buddy companies are in the process of being significantly reduced at a finally accelerating rate. It took many years to get here, but it's accelerating at many firms. Companies are increasingly naked and exposed to the voting of rational institutional and individual shareholders, rather than protected by buddy friends who invest back in them as yes men. So how are these non-buddy investors voting? That brings me to point number 4. Shareholders have become more and more aggressive and careful in their proxy voting, just as was originally envisaged in 2014 when I gave my speech. In 2021, the support vote ratio for the average prime company CEO was 93.4%, which by UK terms is not that high, by the way. But that figure has declined significantly and steadily since then. And so far this year, it has averaged below 90%. Well, that means, if you just think in terms of the math, that there are many CEOs out there who are getting elected with support votes of 80% or less. Otherwise, the decline doesn't add up. When your support vote as CEO gets down to that level, this is how investors punish companies. They vote no for the CEO. The writing is on the wall that the CEO and other board members, or even the persons who selected them in particular, may be kicked out at the next or the next AGM. The writing is on the wall when you get down to that level. And more companies are in that group. Fifth, while all this has been happening, the number of activist funds and shareholder proposals has surged over the past 11 years. In 2014, there were only 8 activists and 4 shareholder proposals by one count. But in 2024 AGM season, last year's AGM season, the same source counted no less than 73 activist funds, 51 by another count, but anyway, there's been a huge increase, let's face it. And a prominent law firm counted that in last year's AGM season, that is the shareholder meeting cycle, there were no less than 385 separate shareholder proposals made to 91 listed firms. That's a lot of companies and a lot of proposals. You can expect as many or more this year. The securities firm that accounted 51 activist funds says that almost all of them outperformed the market in the past few years. I wouldn't be surprised if that's true. And some people say that the time from starting an engagement to getting some meaningful results or actual sincere answer has declined, has shortened. And I think that's probably true. Last year, Strategic Capital, a well-known activist investor, won 3 seats on the Daido board. Toyo Securities President Kuwahara resigned due to shareholder pressure just 1 hour, 1 hour before the AGM. While most proposals are not approved by shareholders, their average support vote ratio is going up. Some 60 proposals got more than 30% of votes, shareholders voted, 30% of voting shareholders voted for them last year, a number that increased from 44 or so the prior year, and only about 9 in 2022. So that's a sharp increase in the level of support vote and the number getting a higher support vote. I might mention that I myself was proposed by an investor to sit on the board of Kirin Holdings in 2020. My nomination was supported by both ISS and Glass Lewis, the well-known major proxy advisors. And at the shareholder meeting, it was supported by 35% of voting investors. At the time, that was a very high support vote. Just as I had done at LiveDoor after the scandal, I made it very clear to the investor and to Kirin and to the public in interviews with newspapers, etc., that I was totally neutral and would be very independent of mind and not a push button for the proposing shareholder. I told the shareholder that too. That was my condition. That was the first thing I said to him over lunch. But for some reason, Kirin viciously opposed me, including a performative, sort of meaningless interview, followed by a suddenly demanded intense grilling meeting by their outside law firm's attorney, with a manager watching and saying almost nothing, in which there were lots of threats about how my reputation would be stained if my name appeared in the proxy as proposed by an activist. CEO Isozaki at Kirin Holdings, who has now been there a total of 12 years now, despite the stock price declining steadily since 2018, has been in the press recently claiming that he met with all the proposed candidates then. But in my case, this simply is not true. I do not know why he says such things, but that's what he says. Many of the proposals by activists and others, especially those proposals for returning unused cash or unnecessary assets via higher dividends or stock buybacks, or those about improving board composition with more independent directors, are supported by non-bank affiliated, non-group affiliated, i.e. objective institutional investors. This was not the case in the early 2000s when we had activism runs at the time that were referred to earlier. Mark my words, not in all cases, but in general, because general portfolio investors tend to be relatively meek of character, as financial institutions often are, on average, it's the activist shareholders who are shaking up and speeding up Japanese executives in a very necessary way. And since they target the worst companies, often this is, for those companies, the only way possible, the only way change is going to happen. The other more normal fund managers, the institutional investors who are active or passive fund managers, but not activists, are quite happy to follow the activists and vote together with them once someone else, namely the activists, have taken the reputational risk. This is essentially the exact same dynamic as occurs in the United States. The difference is that since Japanese executives still make up a majority on many boards, and many still do not receive much or any stock-based incentive compensation, even now, executives here move far too slowly to realize when the game is up. And they should really stop fighting and negotiate for a compromise based on reason and analysis in terms of buybacks, strategy changes, board composition changes, etc. And depending on results, maybe even step down themselves. Point number 6. At the same time, MBOs and TOBs are on the rise. From 25 MBOs in 2021 and 19 in 2022, 2024 saw 37 MBOs, some with rather high price tags. And in just the first 3.5 months of this year, we had 10. So if you extrapolate that, it looks like we're headed for over 40 this year, which would be more than last year. According to one report, the volume of MBOs had quintupled in 2023 to 9.7 billion yen, led, of course, by the buyout of Taisho Pharmaceutical for 710 billion yen. TOBs, takeover bids, which are often a way to do an MBO, but might also be a takeover by an operating company, are on the rapid rise as well. Last year, there were over 90 of them, a peak number since 2007. And we now have unsolicited TOBs, which is a nice way to say hostile TOB. Hostile TOBs have come to Japan. For instance, Daiichi Life's takeover of Benefit One. Daiichi Life, right? Well-known company. In 2023. Nitori's acquisition of Shimachu, or Nidec's acquisition of Takisawa Machine Tools. Others are coming. Thanks to a line that I was able to convince Medi behind the scenes to include in the fair takeover guidelines in 2023, I predict that we will see more unsolicited TOBs, i.e. hostile TOBs, in the next year and after by operating companies, not just quasi-friendly MBOs, by Bain and KKR, et cetera. In fact, if foreign companies were a bit smarter and willing to act faster in Japan, they could also be making many TOBs or requests that might not end up in a TOB, it'd just be a sort of a soft bear hug and not go to a TOB. That's the way you do things in M&A. So we have a lot of very healthy governance changes and reallocation of capital, cash, and resources accelerating, and sometimes much needed consolidation in fragmented industries starting. Some people say, this is what Medi's been looking for a long time, by the way, consolidation, very badly needed in Japan. Some people say that in the prime and standard exchanges, 1 in 6 investors can be identified as an activist, accounting for 1%, or some people say even maybe 4% or 5% of total market capitalization in prime and standard. I don't know if I believe these speculative estimates, but it certainly is true that there are a lot of newbies, sort of new-face activists or quasi-active engagement houses in the market now. Folks that I never heard about until the last year, or even sometimes the last month, most recently. I only wish they knew more about the blood and sweat that was shed in order to get things to this point, where they find Japan to be such an attractive, underpriced, value-playing market. It's taken 30 years to get this far. In conclusion, active fund managers and activist fund managers, director training, and an increasing number of young people with entrepreneurial mindsets. These are the things that will save Japan from the less value retaining, less value creation economic shrinkage, and asset misallocation scenario that this economy faces without these factors. The government knows this, and behind closed doors, for the most part, is pretty happy about the current direction, including the increase in activism. Many may be pressured by the Keidanren on some of this stuff, but at the end, overall, the government has started something it cannot and does not want to stop. Most bureaucrats and smart politicians have finally realized that for many companies, this is the only way those companies will change. The good news, in a sense, is that at this point, all of this is mainly happening without government policies other than keeping up what it's been doing since the governance code and stewardship code were put in place in the first place more than 10 years ago, or about 10 years ago. The government has simply been gradually improving on that basic infrastructure. It could be moving faster, and I have some ideas for that. I'll be happy to share them later on. But at least most in the government and bureaucracy now realize that it's a national imperative that this stuff all work better. And at the end of the day, I would add, 80% of the results will be up to shareholders and how they vote. Shrinkage in this economy may be inevitable, given demographics. But if you can preserve more wealth and increase the vitality and value of managers and young people with entrepreneurial mindsets and the speed of asset reallocation, life here will be very exciting and better from all citizens and their pension funds as well. So if you'd like more information from me, I cannot promise because we're so busy at BDTI training people, but feel free to send an email to info@bdti.org.jp, address it to me, and link up with me in LinkedIn. And please write about BDTI, the history that I described, since no one else here reports on it, and the intense need for more director, governance, and finance training, which is what we provide, before people join boards in Japan. The same old board members who got us in this mess of undervalued potential opportunity will not be the people who get us out of it. Thank you. Those are my comments. And I'd love to have any questions.
All right, thank you, Nick, and thank you for running us through the history of corporate governance reform. I'm going to take my prerogative as MC to ask the first question, which is, I wonder where you think we are today. So 2025, the AGM, the shareholder meeting season is beginning. It's a 10-year process since the corporate governance code change. Where are we today? What are you looking for this season? What are the milestones or bellwethers or key companies you're looking at?
It's very interesting to see what happens with Fuji Media, although that's a very unique case because government policy doesn't allow more than a certain level of foreign ownership. So it's not the bellwether. But I think what I'm looking for, what I foresee will happen in this next AGM cycle is we'll see even more of the same trends. Everything I just discussed, more shareholder proposals, a higher support vote for more of them, a lower support vote for many CEOs who continue to underperform. Since the average PBR, price-book ratio, of prime companies has not increased at all since the TSE started its much ballyhooed policy changes 2 years ago about the cost of capital. We're going to see more activist plays in these coming AGM season in the coming year. And they increasingly will be of various types that you can now sort of look at and see how the activist game is refining itself and it's sort of improving its techniques. You have the force the MBO technique. You have the wolf pack, where more than one activist comes into a company, maybe and probably without any coordination at all. Ganging up, you can call it, but it's a sort of a wolf pack approach. You have the approach of proposing your own candidates for new directors. We're going to see more, I think, of those director proposals than in the past getting accepted in the next year or two. Because more companies, by the way, have promised. Some companies have even promised in the next few years they'll be going to a majority of outside independent directors. And a surprising number of companies already have a majority of outside directors. We will see more activist techniques that appeal to government policy, such as Farallon is doing with T&D Holdings. The FSA forced the Sompo, the casualty insurance companies, to get rid of their cross-shareholdings over the next year or two. And Farallon has taken that on and is asking T&D Holdings to do the same based on that kind of policy. So there are a lot of new techniques that are emerging. I'll go over some of them later on if you like, that are in the quiver of methods that activists can use. Most of these, however, come down to one basic point. Companies have underutilized assets, whether it's too much cash that they're not using, and sometimes, in many cases, this is an extreme amount of cash that's just sitting there earning almost nothing at present bank rates, just doing nothing to protect the company, they think, but actually it makes them a target, so it's kind of ironic, for the future, right? Because they're unsure about their own strategy. It shows incompetence of management and anything else. Or they have a lot of Allegiant holdings or a lot of long-term investment securities, which are sometimes really Allegiant holdings, but they just put them in the wrong basket and call it, oh, it's a long-term investment. Or they have land, which is at a very low book price. There was a case a couple years ago when Hino, I remember the Toyota Group had something on the books at 100 million yen, and they sold it for 50 billion yen. Okay? A lot of these holdings go back in terms of book price many decades. So the activists are now focusing a lot more not only on cash and Allegiant holdings, but also on land, increasingly on land. And that's another technique that's increased. That's the kind of change I'm foreseeing, if that answers your question.
Yeah. So if you have something you'd like to ask, please raise your hands. I do have some questions online. No hands are up, so I think maybe I'll continue then. So there have been, and if you have a question, please raise your hand. Don't hesitate, okay? A couple of questions online. One is the role of the TSE, right, the Tokyo Stock Exchange, which, as you mentioned, has almost become a quasi-activist, right? The CEO
Good for them,
of the TSE has been outspoken. You mentioned the price-to-book ratio, which I think was one of the things TSE has cited.
Right.
Can you talk a little bit more about why the TSE has found religion? What's your sense of what's going on there? Why are they becoming a driver of this? And what can we expect?
They have a new CEO who came from the Osaka Stock Exchange, and before that, Nomura. So he comes from a different sort of background. And that's, of course, one factor. He's been an excellent leader, and kudos to him. That's one factor. But I think a very major factor is that the TSE itself has realized that it's kind of up or out. They have to improve the quality of the companies on their own exchange if they ever hope to remain one of the preeminent stock exchanges in Japan. If things continue on the line we're going, they will be viewed as the unattractive market in Japan, even though it has a lot of companies listed on it. The majority of those companies will be viewed as low PBR, low growth, poorly managed companies without much upside that nobody wants to invest in. At the same time, they're looking over their shoulder at Shenzhen and Shanghai and these markets which already have total market caps way beyond TSEs, right? So they have to improve valuations and attractiveness of companies here so that this country, the TSE's own stock markets, are viewed maybe not as high in market cap as China's, but higher quality in terms of governance, management, and disclosure, so that investors feel more confidence investing in this market. That is their strategy, and they came to the conclusion, I think, which is very logical, that if that means cutting out a lot of people who are not willing to change, and we get lower listing fees, so be it. This is an existential issue for the TSE's effort to remain a preeminent exchange in Japan.
And this is a question from a colleague at Reuters, which follows up on that. So can you talk about the other options? Regional stock markets, other stock markets. As you mentioned, TSE is not the only player in Japan, much less China. Can you talk about the role of other markets?
Well, the TSE is unfortunately a de facto monopolist, and it's by that nature that in the past they've been able to be, if I may say, please don't quote me directly, rather lazy in policing their own governance code since 2015. I'm very happy they suddenly got religion 2 years ago. That's great. It's wonderful. I applaud it. But they are de facto a quasi-monopolist here because the other exchanges are all very small, and foreign investors don't want to participate in those exchanges. So you can kind of write those off as options, in my view.
So the other regional stock markets would not be drivers?
No, I don't think so. No, not in terms of how the Japan stock market is viewed by the most important investors here, which half of them are foreign investors.
Great. Any
new parties we can expect to invest in this market. Yeah.
Great. Okay.
Any other questions? Please don't feel shy. I won't bark.
I have more online.
I won't bite.
We got
great.
More.
Okay,
So
good.
One is you mentioned buybacks, and there is sort of this feeling maybe there's a pushback against buybacks, or maybe buybacks are a little bit passé or something. It feels like there was like a
pushback against buybacks. That's a good one. Yeah.
What's your take on that? Like from a corporate governance perspective,
Well, from a corporate governance perspective, the purpose, the role, the duty of an executive, a CEO in particular, is to find new projects to invest in that we expect will result in returns that exceed our cost of capital. That is your job description for which you're paid a reasonable amount of money, and if you do it well, we're happy as shareholders to give you much more money in terms of stock incentive and that sort of thing. That is the job of the CEO and executives. So if you have all this cash lying around, but you don't have enough innovative ideas or ideas from alliance partners or your management staff or your own head on new things to invest and ways to extend your technologies or acquire new companies, add new channels as the way to invest it, and you just let it sit in the bank. Basically, if you take that and write it in reverse, you're not doing your job to have that much cash. Now, every company needs a certain amount of cash on the books as part of working capital in case there's a COVID or a business tariff hit or something like that. And so everybody needs a little bit of a cushion. We all know this. This is part of working capital in a sense for risk management purposes. But we're talking about a very, very large amount of companies that have cash far, far in excess of that level. Or land holdings if they were to sell, or stock holdings, et cetera, that if they were to sell, that would increase that amount even more. The numbers are really quite stunning as to how much totally underutilized, getting bank interest at 0.6%, if that, is lying on the books of Japanese companies. And all those other assets are very saleable. In fact, now, in terms of land, probably is a good time to sell, given the fact that the BOJ is poised to raise interest rates, and that's what influences the price of land in a very direct way often. So over the next few years, if you're a smart executive, you should be thinking about selling land anyway, is my book. Does that have to answer the question? Please ask more. I have not done enough. Yeah.
I have another question here from an associate member. So the tariffs, you mentioned tariffs may be a good segue to this one. For example, Seven and I, you have Couche-Tard, a Canadian company, sniffing around the edges or more. In this age we have of populist nationalism and seems like a nationalist pushback of sorts against globalism. Is there a reluctance to sell national champions abroad? Can we expect, for example, there to be some sort of systemic or government reluctance, for example, to allow a Seven and I to be purchased by a non-Japanese company, a national champion like Seven and I? I mean, there is a kind of a global current that is running contrary to sort of this, sort of the free flow of capital that you were mentioning. I just wonder what your thoughts are on that.
Sure. There are some industries that are strategically important to any country. This is true. In the U.S., arguably, steel may be one of them. You can't exactly take the steel, as Mr. Trump said, take the steel factories and ship them to Tokyo. Even if you could, you'd be confronting unions and labor costs there, which would not make things much better. So, but I guess the major thing to think about is that this is a little bit of a distracted red herring. This is not a major issue in my view, and I'll tell you why I think that. Even the United States can only claim a certain number of industries to be strategic. Things related to AI, semiconductors, et cetera, given China. There's a list of things there, maybe steel, and what they're going to come up with anyway is a sale to Nippon Steel, which probably, the management of which is American, but not the ownership is majority American. And it would be 100% Nippon Steel, most likely. And they'll call it an American company because the management is American, something like that. But at any rate, the number of industries in which this kind of thing can affect you is not that great. Now, Japan has a system, and everyone's very critical of it sometimes, but this is, I think, not a bad thing at all. Years ago, and this goes back maybe 15 years or so, I used to have, yearly discussions with Mehdi when I was at the American Chamber of Commerce, and then even afterwards maintaining discussion, back channels with them, still have them now. They were saying, geez, we need takeover defenses to prevent acquisitions in all these areas. And I say, well, look, you don't need to increase and make it very easy to say no, absolutely, with nobody as independent directors opining on the use of the takeover defense. You don't need to go that far. Just do what the United States does and use your own existing law, which describes certain industries as things which foreign investors should not be investing more than a certain amount in. In the case of television broadcasting, I think it's 30%, or weapons and that kind of thing have restrictions. They already had a law like that. I said, you got to use your own law. You just have to make it much more tight the way the United States does. Copy the United States. I had this discussion with them 15 years ago, and they say, our own law, tighten up in the industries we consider important only, in a very specific, targeted way. That's a good idea. They weren't considering their own law at that time. And so what they've done since then has been exactly that in a more thought-through process. But it will not cut out most transactions that could be taking place by foreign companies and foreign operating companies. When you talk about champions, then you have to ask, okay, we don't like the idea of Couche-Tard taking over 7-Eleven on emotional reasons, but we have to really kind of think hard, why do we consider that to be so bad? If Couche-Tard owned 7-Eleven, Can they take the stores to Canada? What can they do? You know, and so that discussion, if it takes place and that debate takes place, I think it's a very healthy one in terms of really trying to figure out, just as the United States has to really try and figure out now, how to protect things which really are important to you strategically from outside control that is excessive and might hurt you, and separate those out from the things where it's just kind of emotion run awry, overcoming and dampening market efficiency, which would actually help the economy more. Foreign investment in general is good for any country. It's good for the United States. It's good for Japan. To have a better owner with new technology, to have Nippon Steel injecting its technology into U.S. Steel is a great thing. So we don't want to dampen that and throw the baby with the bathwater.
You mentioned your experience with Medi. There is the argument that convenience stores are strategic. That's been made by some people. At the same time, you mentioned that they're like secretly or behind closed doors, there's a welcoming of activists as drivers of change. Where do you think Japan falls on that one?
Well, you know, do you want me to restrict it to 7-Eleven or I'm sorry?
You don't have to speak about any particular company, but there is that issue. Like, it seems like Medi is going to be, you know, you have kind of both poles, right?
Well, Medi's job is a regulator of certain industries. Medi's job, I don't think, should be to be the only agency in charge of deciding what is strategically necessary for Japan's future and what is not. I think that's something for the Cabinet Office. Medi gets involved in these things with lots of leadership-type initiatives that they sponsor, you know, primarily because for the last 30 years, they have been the ministry in a deregulating universe that needed to find new jobs for itself to justify its budget. That's why Medi has been so aggressive in all these things. And so whether they should be the only parties deciding all these things, I don't personally agree with. And they have, if I say it too directly, I'm very sorry, Medi has messed up a lot of stuff in this country's corporate governance infrastructure. We are the only country I know among sophisticated developed countries that have not one corporate governance framework, legal corporate governance framework for listed companies. Not two separate legal frameworks for corporate governance, but three. Three different, separate, hard to understand because there's three of them, corporate governance frameworks, kikan sekkei, have to be understood by investors to invest in this market. Most investors don't understand them at all. That's why we need to train investors as well at BDTI. The people who created this are Medi. And that is why when I proposed the governance code, I did not want Medi to be in charge of it. They would just troll out another structure again and say, okay, we've solved the immediate problem, and nothing would actually happen. It would make things worse. They had made a lot of things worse, and they also improved a lot of other things. We shouldn't view them in black and white, you know, they're perfectly, nobody's perfect, right? But there are certain things that they really do not have jurisdiction over that they're opining on. FSA has jurisdiction, and the FSA has to exercise moral leadership. And when it comes to financial markets and corporate governance, it is the FSA who legally, in their establishment law, has jurisdiction and, in fact, duty to do other things to regulate and push initiatives ahead and make proposals to the Diet about capital markets efficiency in the stock market and corporate governance and that sort of thing. It's not Medi.
There's a question on TOBs. You mentioned that TOBs, that takeovers, including hostile takeovers, will increase. Why? Why do you think that is? What would make that more socially acceptable and more commonplace?
Well, you've already had several. You know, you had Nidek Takisawa, you had Shimachu and who was it? Shimamura. And you had Benefit One by Daiichi Life, which was really a historical transaction. These have taken place, and there was no public revolt in the street, no complaint by anyone in the government, no complaint by Medi. Medi is actually quite happy to see more TOBs, hostile or not, because they will lead to more consolidation. For literally decades, I have had discussions with senior people at Medi where they're telling me, Nick, we know we need better governance. You're right. can you please convince the Keidanren? And I would say, no, that's not my job. That's your job. You're the regulator. And little old me at the ACCJ or not, I can't convince the Keidanren to do anything. But they didn't have, because the Keidanren was their sort of their chief sponsor, they had to get the Keidanren to agree to anything before they could publicly propose it. And they were stuck by that, and that's why they shouldn't be in charge of corporate governance. I lost my train of thought.
Oh, it's just, why more TOBs?
Well, yeah, okay. So anyway, the next part of the discussion will go like this. We know and we want there to be much more M&A because we know we have many fragmented industries. Retailing is a very good example, but there are many industries here. Banking is another, which are fragmented. And there's not enough M&A taking place between to consolidate and get efficiencies, et cetera, access to new channels. Foreign players could come in and give a productivity boost to a lot of these firms as well. We know we need a lot more consolidation. We just don't want the Chinese to come in. That was the discussion 12 years more ago. That's still the mindset. Mm-hmm. And so, okay, find a way to structure your FDI restrictions to retain, as it were, some discretionary ability to keep bad actors or bad parties out in industries that you've actually gone through an analytical process and identified as being truly strategically necessary versus just emotional.
This is a question from an associate member, which a little bit of a jump here, but it gets
Sure.
to sort of your core, what you do. And I know you touched on this. Maybe if you could elaborate a bit more. Japanese companies are filled with directors from within the company. U.S., U.K., you have directors who are not from within the company. That fundamental difference. The question is whether you could expound a bit on that difference and what that means. And
well, all the inside directors on a Japanese board are all subordinates of the CEO. Mm-hmm. Mm-hmm. He often, in most cases, is the chair. That's a very powerful seat to sit in on a board. He's their boss, so at the board meeting, they're not going to say anything that runs against his opinion. Mm-hmm. In my view, they're sort of wasted seats, wasted board member seats, because they may explain things internally, but then we can bring in any executive we want to explain anything internally. He doesn't have to be a board member to explain our financial capital policy, our new strategy, and X, Y, Z, whatnot. It doesn't have to be a board member to do that. Mm-hmm. They're there basically to pack the board so that the outside directors don't have a majority. Mm-hmm. That's why they're there. And that's exactly why we have to change Japanese boards so that a majority of truly independent directors is required under the governance code, which was the original objective when I proposed the governance code and insisted, along with others, but I was the initial person, insisted vehemently to the end that the first governance code require multiple independent directors. Why? Because unless you have multiple independent directors, you can't form committees. You can't have a committee with only one independent director, right? That's not a committee. You need multiple. You need two or more. So what the best we could get the Sangyokai, the Keidanren, et cetera, to agree with was multiple after fist fights and lots of resistance. So we got multiple. And after that, it's been increased to 1/3 for prime. We got up to 1/3. Now, I thought we would get there a lot sooner, but finally we're at 1/3. And we have a lot of companies now where things are accelerating, where there are, I forget the exact number, but something like 150 companies now that have actually a majority of outside directors, if not independent directors. So people are seeing the writing on the wall and going there. When you cross the line, over 50% and 60, 70, 80% of the board is independent outside directors, the entire power balance and the kuki, right, the atmosphere on the board changes radically. Because no longer is it the case that the inside directors can outvote all of us outside directors, even if we maintain a phalanx. We can outvote them if we simply agree. We may not always agree, and believe me, outside directors tend to be like herding cats so that they don't always agree. Okay, that's just the reality of boards. But when 80% of the board is as Advantist, I sit on the board of Advantist, basically 80% of our board is independent outside directors. The discussions become much more respectful to outside directors. The attitude of the CEO and others, internal directors and executives towards the boards becomes one of, we report to you. We are accountable to you, outside directors, and we are accountable to the board in general, rather than we're accountable to the CEO. I'm watching the CEO, as we say, CEO no kao o miru. That's what you get when you have a minority of outside directors. Everyone's watching the CEO, and I don't want to say anything he reacts badly against, right? Even the outside directors, who were kind of invited by him personally in many cases, when you get to the point where 80% of the board is independent outside directors, at least half of those guys can be people who actually view their reputations and maintaining them as important. They will say, no, wait a minute, I want to ask the hard questions here. Is this strategy really going to work? And how have you thought of this problem? And why are we holding these assets? And other people may disagree, but you're going to get a very healthy debate. And at the end of the day, you're going to put things in the minutes, and you're probably going to win those rational debates. Why? Because you have a majority. The atmosphere changes radically once you get to 60, 70%, et cetera.
We have time for one more question. Does somebody, sir, would you? We have a microphone coming. Hold on just one moment.
Myself is actually I'm a colleague of Nick.
That's okay. Please identify yourself. We allow friends.
The BDTI recently.
You're a director at BDTI.
Yeah.
Yes, right.
What's your name, sir? You please identify yourself.
Oh, yeah. My name is Tad Nishida. Yeah, nice to meet you. I have a little good timely question. If you see a political scene in Japan, people start to expect that we might have somebody from opposition party become a lead in the prime minister office. We don't know, but would that make some impact on the political scene and also the way how the corporate governance works in the future? If there are any signs, let me know.
I've seen zero sign of that. In fact, I think that actually might be a positive change, because competition between political parties will lead them to actually think more and talk more with outside people like myself and academics, which are chronically underutilized in Japan, about what is a better analysis, better policy. Competition is always good for markets and the pricing of deals, and as it is probably also in the policy world. And I see no other than the Kyosanto, which is, the Communist Party is not going to get elected here. I see nothing to suggest that the people in the opposition parties are against any of these governance things. The public is now generally for all this change and views it positively, which is a very major change from 10 or 15 years ago, extremely major. And those are people who vote those folks in. So, if anything, I think it might be a good thing if the opposition parties would come into play, and you might have a sort of reversal of what happened when the second Abe administration came in, when they behaved, because they had been kicked out once, they knew they had to do something, new in reform, right? Because the Minshito Democratic Party had tried to do something new, and it was applauded at first, but messed up and did it very incompetently. But they knew this time there was going to be no second chance. And when Abe came in the second time, they knew they had to make a lot of things that actually the Democratic Party set up, like outside directors. That came from them originally. If you know the history, and I'll explain details later, but it came from them, not the LDP originally. They knew they had to make things work when they came in again. That kind of competition would be a very good thing.
Thanks.
Okay. Any other questions from the folks here? You want to?
Please.
Sir, please identify yourself.
I'm Yoshiki Tsurumaki, Japanese lawyer of King & Parsons. Thank you for presentation. I want to ask about Japanese slow decision culture.
Good question.
In case of Kushida offer, 11 months has passed. The Semi Holding received their offer. Mm-hmm. So, from your perspective or global investor perspective, how do you think about Japanese this culture? Should be fixed or acceptable?
Well, it's not acceptable. It's too slow. But that is, for Japan, if anything, fast. So, that's kind of where we are. If it was the United States, they would set up an independent committee immediately. They would discuss, more with Kuchtara than Seven and I did at first to understand what they really want to do. And they would, use competition to, seek out other possible buyers, other than just, the family itself, et cetera. And things would have proceeded. But now I understand that Stephen Dacus is proceeding in a rather logical way by allowing Kuchtara to do some level of, maybe limited, but some level of actual due diligence. And probably that will lead in the direction of Kuchtara buying the New York, not New York, the U.S. chain of convenience stores, which I guess are not performing all that well, and Kuchtara can probably increase the efficiency of, or some transaction like that. But it might lead, who knows, to an understanding between the companies where, gee, if we combine, if we can just get it past the antitrust authorities, maybe this is a really winning combination. The more people, and human beings are like that, the more they actually get together and talk and exchange ideas and information, they start to be more reasonable and see ideas they didn't see before and they rejected it first. So this is happening probably because of Stephen Dacus. And slow decision-making in general, though, is an extremely good question because this is what we have to speed up in Japan. That's absolutely right. Speeding up decision-making requires outside directors. Internal consensus-making is very slow in Japan. We never want to change anything that influences employment or the status quo too much. We're scared of that. There's a lot of hesitance to suggest that internally. And so a lot of things, the most sensitive issues that have to be done the most, don't come up through the internal chain of decision-making from the planning department. It should. Some of them do, but a lot of them don't. And it's really, to speed things up, you need some catalyst like an outside director like myself who obstreperously says, why aren't we considering X, Y, Z? And have you looked at what the competition is doing over here? Why aren't we doing something like that? Can you come back and investigate that and analyze it? You're not analyzing it? Nobody's in charge of analyzing that? You need somebody sort of stirring things up to overcome the slowness, or it will just go on being sluggish and the board meeting will be almost meaningless in a sense. The job of the board is to prod, encourage, facilitate, but also softly and sometimes strongly demand more analysis, faster analysis, more ideas, more alternatives, and deeper strategic thinking than is taking place internally. That's why, again, we need well-trained, competent outside independent directors to be a majority of boards, and then you'll speed things up. Because management's heads will probably be on the line. Their promotions, and we'll have, with more equity incentives as well, their incentives as well, their compensation will also lead in the right direction of wanting to do all this stuff in the first place. So that's a virtuous cycle.
Any more questions? Anybody want to ask anything? We're good.
Please.
Hi, I'm Sayaka from Junker Partners, and I want to ask this now. Japan is a real turning point or not, because now Japanese corporate is welcoming a lot of the investors, a lot of the activists. And I remember when I was in investment banking, I was belongs to the anti-activist team, which means the company is thinking the activist is techie, kind of techie.
You're defensive, yeah.
Yes,
enemy,
yes.
yeah.
So we are advising to our client how to protect the company from the bad activists.
Right.
But I think the activist quality is also changing. So previously,
Yes.
Murakami Fund was asking for more dividend or something. But
Right.
now people really understand about the corporate strategy and business. So working with activists is a very good thing for the
That's right, yeah. The activists
company.
are often the very best advisors.
And my question is now real turning point for Japanese corporate or not? Because I'm new to the market, so I only know this 5 years, 10 years. But is this kind of change is happening from last 30 years or something?
Well, I've been saying for the last 15 years the same thing, that change is always slower in Japan, because I've been here a long time, many decades, 1975, right? Change always happens in Japan slower than you thought it would or hoped it would. That's just the reality of the market here. And when it's, in the worst case, it ends up being a frog in the pot where the hot water goes hotter and hotter, and it boils and the frog never jumps out because he never decides to leap, slow decision making. But I do believe that right now, in the last 5-10 years, because of all these changes I discussed, the second derivative, i.e. the rate of acceleration of change, is increasing. So slow change at first, but the pace of that change is increasing to the point now we are at a turning point. Not for all companies, however. Those companies that are smart enough to get it and engage and talk reasonably and do analysis and realize that the game is up, shareholders are now going to be controlling you more. They do own the company after all. Realize that and sit down with activists sooner and have a real engagement process and discussion. And then I have to agree with everything, but compromise the things that are reasonable, right? Because a lot of these ideas are very good because activists do a lot of great study and research about companies before they invest in them. Those companies will do a turning point and PBR will raise and this kind of stuff will be good. Assets that are underutilized will be hived off and consolidation and these kind of transactions will happen. But another sort of half of companies will not get it. And they will go into even lower PBRs and you're going to have even lower support rates for those CEOs. And they're going to turn to takeover targets, many of them. Now, some of them may go bankrupt because they end up going down a strategic route where they have to actually spend that cash, et cetera, and they just held out for so long, and nobody wants the business anyway because the management is just so stupid. And some of them, another group will do MBOs. This is a very, very strong trend. You have a lot of listed subsidiaries. I can go through a long list here, but there's a huge number of companies that are 50%, 30%, 55% held by some other major company. Canon Marketing, 57% held by Canon, Fujitsu General. Fujitsu owns 42%. All these things will probably be either bought out by the parent company or some kind of MBO will take place. So is that getting it? Sort of, in a way. It is speeding up the metabolism and reallocation of assets in a more effective way, even though we may have a lower number of listed companies. So sort of mixed. We are at a turning point, though, and it's a very healthy one in general.
Yeah, as an investor, I think some Japanese companies are really stubborn and
Yes.
they don't want to change.
That's right.
Even they have a really bad corporate governance. So
Yes.
I'm wondering this is a chance for us or not.
It is a chance for you. The issue is, as an activist, is that it takes a lot of time and money and people and research, to research these companies to the point where you can really come into them with, the 200-page report that kind of knows their company better than they ever did because they're not doing this kind of analysis they should be doing internally. If in the worst case, the FSA changes the rules, so, for instance, if the investors have to report holdings of more than 1%, for instance, as soon as they even take that kind of low level of stake, it will prevent activists from buying into companies for assembling a stake at a low price that justifies, is low enough to justify investing all these resources in researching companies. So even though I have suggested that there be more disclosure about who are our shareholders, I really don't want the government to touch with that too soon and require full disclosure of all your shareholders, beneficial holders included, too soon, because it will throw a wet blanket over the incentives for activists to do this research that justifies making that investment up to 10% or 5% before it needs to be disclosed. And it's that kind of holding which can have an impact on these companies. It's the only thing that will change that kind of company.
Do we have time for one more question, Saikawa-san? Do we have time for one more? Okay, because we got one more online. Thank you, Sayaka. We got one more online. So I'm going to read it to you. Just
Please.
Some critics say that many of these MBOs, these management buyouts, are squeeze outs
Yes.
of minority shareholders at unfairly low prices,
Right.
Usually conducted by founding families or management. What's your view on that?
Well, a prime example of that is in the news as of yesterday, which is Tokyo Industries and Toyota. That essentially is what you just described. And so that's correct. And that's why even the TSE, God bless them though, I'm happy they're doing this, is now talking about rules that prevent, that require the use of independent committees that are more diligent to avoid mispricing of MBOs. The problem, however, is that we don't have the same sort of legal requirements as we do in the United States that require the independent committee to actually go out and get competitive bids in these kind of situations. That is what needs to happen in order for independent committees to be at liability risk if they don't go out and get competition. Competition is what raises the price. I have doubled, literally doubled, the price of M&A deals by using competitive auctions. Competition is gold. And the legal regime doesn't require that. That is something that the MOJ and MEDI and FSA should be putting together, should have put together some time ago, but they never have. And in the absence of that, you have this comply or explain sort of, it's too soft requirement, and it's left up to shareholders to sue the independent committees later on after the fact. The good news, though, is that even the courts are starting to understand the fact that legal liability if the independent committee doesn't do its work properly will be imposed. In the Family Mart court case, there was a reference to this by some of the judges. In that case, the minutes of the independent committee were court evidence, and the fact that the committee at one point didn't appear to be acting totally independent came to light, and there's sort of dicta, as we say in court cases, indicating that independent directors could be at much higher liability than they thought they were before. And that will get out to those directors, independent directors who study and learn from people like us about their liabilities and duties. Those that don't may end up getting sued. In fact, the directors at Tokyo Industries may end up getting sued here. In fact, I almost hope they do end up getting sued here, because that's a transaction which is obviously mispriced, right? Tokyo Industries' stock price dropped by 12% overnight on the release of the information, because shareholders had a right to get much more than just book value, for Tokyo Industries stock. There's huge hidden value, hidden asset value in the land and other holdings at Tokyo Industries. The price should have been much higher. So what was the independent committee doing? Was it getting bids from other parties? Was it valuing the land at market value? Clearly not. They were simply taking the orders from Mr. Toyota and others and agreeing to a transaction which was grossly underpriced. And the market stock price movement at the time, overnight, reflects that. Even Toyota's stock price, not just Tokyo Industries, jumped down at first, you saw, and then somebody jumped in to try to protect it and move it up. But at first, it jumped down this morning. So that's a prime example, and you're going to see more examples of that. When people get sued and criticized, then these things will stop happening, and the independent committees will become more meaningful.
Well, we've gone over time, but it was a very interesting and timely topic. So thank you so much, Nick, for joining us today and for speaking to us. I wonder if we can give a round of applause to our speaker for coming. Thank you very much.
Thank you for having me. Thank you very much. Thank you.
And as is our tradition, we offer our speakers a 1-year honorary membership at the club. So, Nick, you are now a 1-year member.
Thank you very much. I've been a member before, and I'm
well, please come again.
Second time I'm honorary member, so I'm very honored.
I hope to see you around.
Extremely honored. Thank you very much.
I hope to see you around the club. But again, thank you very much for your for coming today. Thank you.
You're quite
very much.
welcome. Great
Thank you
to
very
see you
much.
again, Martin. Thank you, everyone. Thank you.
And that that concludes today's event, and thank you all for joining us in person and online.